What are some of the lessons that we can learn from the gold mining futures crash of 1999? Hello, everyone. My name is John Taylor from Bitcoin Mining World, and you're watching the 256 Report, where we talk about things that are interesting to Bitcoin miners. In 1999, there was a big gold market crash due to mining. And what are some of the lessons that we can learn? But before we get into that, Bitcoin Mining World is here to help you get into the mining business through education and equipment. Whether you're looking for a site or you're looking to purchase equipment to put into a site or a hosting program, let's connect on how we can help you get into the Bitcoin mining business. Just announced the Bitcoin Mining World Conference on March 11th, a full day of world-changing speakers and presentations to help you optimize and build your Bitcoin mining business. Be sure to join us on March 11th for this upcoming event. Please welcome my first guest. Like I said earlier, our first guest is Ari Pine from Blockfills. And Ari, how are you doing today?
I'm doing very well. Thank you for having me, John.
All right, so we talked earlier about gold, and there was some lessons that can be learned back in 1999 about the gold industry that could be relevant to things that are happening in Bitcoin. Before we get into that, tell us a little bit about yourself.
Hi, thanks for having me, John. Really enjoyed meeting you in Texas and appreciate you inviting me on. Yeah, my background is, I guess, kind of not too unusual for someone of my age right now from Wall Street, in that I have an engineering degree and I got involved in trading. I started out trading bonds at JP Morgan, moved into options on the Pacific Exchange, and then on to similar at the Commodity Exchange, which is where I got some of the knowledge about the gold market, is because I was running a gold options market making operation for a number of years, and this all came into the trading lore of our trading pit, because we did trade the options and the futures traded right next to us. And for those who are unfamiliar, because they're used to electronic markets, this was back at a time when, I wore one of those color jackets and would yell and scream. And even when I started, actually, the futures themselves we used hand signals to communicate levels and buying and selling there. And it took some time before it really became electronic.
What exactly happened back then?
So the environment in the 90s was that, in particular, the European central banks had figured, look, we have all of this gold on our balance sheet. It's not really doing anything. It's not like, treasury bonds that are earning us interest. It's just an inert metal, right? And why not sell it? Right? We've got thousands of ounces. And so the central banks went about, they went about it in a way that, in retrospect, seems a little bit naive, right? They announced that they were going to be selling their gold. They held it in regular auctions. And unsurprisingly, the price of gold versus other commodities started declining. And it just kept going down farther and farther. Now, the gold miners used to view their source of value to investors in a couple of different ways. The first was they could, unsurprisingly, get gold out of the ground, right? Which is what we all think of. And then on top of that, they were valued because they had reserves and they would hold gold, and they had this sort of correlation to gold itself. Not only their value as a business in terms of taking ore, refining it, and shipping it off, or digging it out of the ground and so on, but they also were viewed as being a substitute for gold itself. And if you are a substitute for gold itself, and all of a sudden the price of whatever that asset is, in this case gold, starts declining on a regular and sustained basis, and you know that there are large sellers, like some of the largest holders of gold, are going to be continuously selling, you need to take an action plan. So that's what they did. And many of the producers began hedging their production, which makes sense. And as that worked better and better, more and more miners participated in hedging. And as that further worked, and it then became into common usage, and it became a problem if you didn't hedge, right? Because your competitors had an advantage over you. And so people ultimately decided it was better to be short gold than long gold. And so they wouldn't actually be short gold, but what some of them started to do, and in particular, there's one miner that's pretty well documented named Ashanti Gold, decided that they would actually not only hedge their sort of forward production over the near term, but they would actually hedge all of their reserves. Okay, so you figure they have it. However, the trouble with that is it's not out of the ground yet. And if you hedge something that has not been taken out of the ground yet, that isn't easily accessible, and somebody says, look, I bought that futures contract from you, they're going to want either the money or the gold. It's pretty straightforward in terms of what the other side of the contract wants. And because it was still in the ground and had no particular near-term consequence to be out of the ground, that meant that they had a problem if the price of gold went higher. What then happened was the Bank of England had its last gold sale. I think they sold it at the low of like 277 or something like that. Something that seems absolutely ludicrous now as it's 10 times the price. But they essentially, to make a bad pun, sold it into the hole. And once that was done, there really wasn't big sellers. As a matter of fact, a lot of people had accumulated that gold in anticipation of the last trade, right? So you can imagine when a big trade comes in, you don't want to participate until that last part that is your size. You want to grab the last bit. Then once they're done, the selling pressure, or in the reverse, buying pressure goes away, and then the price ought to reverse. And in fact, that's what happened. And so once it started going up, all of these contracts that Ashanti had on, and they were with the big banks, they weren't necessarily on exchange. And it's been some time since I looked at the history, so I don't remember what proportions. But the bottom line is, whether it's at the bank or at the exchange, one has to post margin against it. And as the price kept going up, Ashanti had to post money that it did not have, right? It could only produce gold at a certain rate, and then its margin, and then the money that it had could not come any faster. And ultimately, those that had extended this credit to them in the form of these futures contracts and forward contracts and options and so on, said no more. And that's where we get back from, people deciding to, for lack of a better term, the margin clerks going, that's it, you're done. It doesn't matter what you say anymore. We're at that point. And then the people that had bought the contracts from them had to go in and replace them. And that's what happened. And then gold went higher, volatility went higher, the prices of calls versus puts went higher, calendar spreads went bananas, and it really changed the entire market microstructure of what people had become used to in terms of what was what as a trader you might call your mental database of price action, the way that things move together, and so on. And Ashanti ended up bankrupting itself, right? And so it would be easy to dismiss this as, hey, don't hedge. But I don't really think that's the lesson here. I think the lesson here really is more about um, paying attention to what's going on, making sure that you've entered into contracts that you can get out of, that you can manage the leverage and embedded leverage in, that you have a way to make sure that you can always make good on the margin. And then, really understand that, depending on who you speak to, the Chinese proverb, this too shall pass, is a real thing. And price going down or price going up is not going to happen forever. And so one needs to be appropriately prepared for both circumstances.
I think the takeaway that we can get from this is that if you're going to leverage or, you know, do anything like that for your company, you have to set limits and have it be a balanced strategic part of your future. And if it sounds too good to be true and you have that gut feeling like, I think I'm overextending myself, that may be the case. And it's not a good strategy for long term success. Thank you so much, Ari. This has been fascinating. And I look forward to having you again on next week.
That's great. I thank you very much.
That was a fascinating conversation with Ari, and we have another one scheduled for next week. So be sure to join us every day on the 256 Report. Till tomorrow, see you then.